Hey folks, it's time we talk about covered calls, the classic bread and butter option strategy. It's an introductory strategy that a lot of people get started trading options with. Relatively low risk, certainly compared to some of the other trades you've probably been doing, and easy to execute. And frankly, it's just a bellwether. It consistently turns profit month after month, year after year. So we're going to talk about that just a little bit here. If you don't know me, I'm Jeremy Whaley from Trade Maestro, and it's great to have you with me. If you've not done so already, please like and subscribe to the channel so you get the updates and notifications and everything whenever they come out. And then you will not just randomly find a video, but rather you will be prepared for the videos. All right, let's get started here and talk about covered calls. And this is I'm going to have a little bit more slides for this particular presentation because I think it's useful as we're going into a lot of details here. I'm going to give you kind of a strategic overview, and then we're going to look at some of the individual specifics and the steps that are involved with writing covered calls. So first of all, let's look at the overview, big picture concept. This is a compound option strategy. What do I mean by that? It means that it's not just going out and buying a call. It's not just buying a put. It is more than one leg. And in this case, it is a stock leg and an option leg. So you can have a stock leg where you buy the stock. You can have an option leg where you sell the call. And you can do this at the same time. You can execute it, at the exact same time, same order form, or most people tend to buy the stock first and then they step into it by adding the call at a different time. And however you do it, it doesn't matter. It's just the end result that matters. That's what creates the covered call itself. So that is the overview. Let's talk about first steps. The first step that's going to be involved is just buying the stock. And this is your standard run-of-the-mill long stock trade. You can see on the right side of the screen here that your risk profile for that is if the stock goes up, then you make a profit. Stock goes down, you lose money. Your standard linear move that you're all used to by buying stock. Now, whenever you buy a long stock, you get all the benefits of stock ownership. You own part of the company. If they're paying dividends, you receive the dividends. If you're wanting to make money with it, you're looking for a capital gain. Your ownership doesn't stop. There's no time decay. It's all the typical stuff that you are used to with owning stock. That's what you get whenever you buy a long stock, because that's exactly what it is. So this is your, like on a chart, make money if it goes up, lose money if it goes down. Just a straight linear move. All right. Now, step two, this is where we start to add the options in. And in step two, what we're going to do is we're going to sell somebody else the right to buy the stock. And that is a call option. If you remember your option definitions, the right to buy at or before a specific date, right to buy a stock for a specific price on or before a specific date, that is your call option. And if we sell that to somebody else, then what do? We become obligated to sell them the stock. So we're selling somebody else the right to buy it. That's a call option. We become obligated to fulfill at that strike price, whatever that strike price is. And consequently, we are now obligated to sell at that price. That's how we would deliver on that contract. All right, now, why would we do that? And the answer is because we're seeking to capture time decay. Before I move on to the time decay chart, I want to show you this risk profile on the right side here. You'll notice that everything changed. When you looked at the long stock, if the trade goes up, then you make a profit, trade goes down, you lose money. With the call, if you're selling a call option, if the price goes up, you actually lose money. And if the price goes down, then you reach your maximum profit. That's your risk profile for a short call. And I want to highlight this because I want you to realize that when we marry these two strategies together, when you take a long stock and you take a short call, you're actually marrying a long bullish strategy, buying the stock, and a bearish strategy, shorting a call. You're putting those two together, so it becomes a little bit of a neutral strategy. That's really the best way to use this. Now, again, why would somebody want to do it? The answer is time decay. So if you've not seen this chart before, this is a theoretical model of how your option time decay wipes out the value of the option over time. And you can see as you get closer and closer to expiration, all the way out at 6 weeks, you can see the orange line there. It's not losing a lot of premium, but as you get to 3 weeks and then 2 weeks and then 1 week, that premium just completely falls out. And that's where you reach the maximum realization of your profit. Now, if you think, well, that's just theoretical, well, here's a real one. This is an actual theta chart for SPY, and you can see how similar it is. Over time, it's a very slow erosion, but those last 2 or 3 weeks, it's very, very quick, okay? So what that translates to on a chart is this right here. Let's say that you sold a call option at 275, well, you get paid up front. That's the benefit of selling your options, right? You get paid up front. You make money if the stock goes down. You make money if the stock stays the same price. But if the stock goes up, you have unlimited risk. That's the danger of the uncovered call. By just selling a call option, that's the danger. And so we combine it with a long stock, that's step 3, to create a covered call. And what the covered call does is it marries those two strategies together. And you can see on the right side of this slide here that the risk profile has changed. Now, if the stock goes up, we reach profit, but we have a cap to the profit. That's because of the short call. And if the stock comes down, then we lose money. Now, you may or may not recognize yet, hopefully you'll soon recognize, that's the same downside risk as owning a stock. So whenever you do a covered call, it has the downside risk of owning the stock, but it caps the upside profit potential. And that's the easiest way to say that. So whenever you do a covered call, here's what happens. We combine the stock with the short call. You sell a call on a stock that you own. You need to own the stock first. It limits the upside potential, but it also limits the risk of the short call. So if you didn't pick that up, you no longer have the unlimited risk of selling an option. You now have limited that because it's covered. And that's why people like to do it. And more importantly, because it creates predictable income. How is it predictable? Well, you receive that premium up front. You've already seen the time decay chart. It decays over time, and you receive that premium. So here's what it looks like. If we were to sell a covered call, we own the stock. We are covered. If the stock goes up, you do not have an unlimited risk like you would with a uncovered call. You cannot lose more money than you originally put at risk. So it's the same risk profile as buying the stock. And you're still going to receive that option premium, which, by the way, is guaranteed. Now, I want to be really careful. There's not a lot of guarantees in the stock market, but one thing that is guaranteed is when you sell an option premium, you receive that premium. And there's a lot of people that will, kind of mess this up. They'll say, well, I received the money, but I didn't realize it yet. That's a true statement. You realize it when the option expires. However, you receive it either way. And so just because you haven't got to expiration doesn't mean that you didn't receive the money. The only way that that would change is if you decided to close it early. If you let that option expire, you receive that money. Now, the trade may have kind of gone against you. You may end up, selling the option or selling the stock, I should say. Or in the case of a naked put, you may end up buying the stock. But you're going to receive that premium. That is yours. It's one of the few guarantees that we can really bank on in the market. And that's why we do it. So if we were to say, why do people do this strategy? It's really simple. You're guaranteed to make your premium right there. It is a guaranteed premium. It's a predictable way to create income. It will help you increase your return on investment, especially during a sideways market and during a bearish market. It will help you lower your cost basis. And if you do decide that, hey, I don't like this obligation, I don't want to be called out of the trade, I don't like what I've done, you can always buy to close it early. So you can remove any obligation. Just because you sold the option doesn't mean that you're stuck in like this, irrevocable contract and you have to sell. You're obligated to sell, but you can buy that back. And that's where the muddy waters get. And I don't want to go too far into the weeds right here, but where people say, oh, I didn't realize the profit because we didn't get to expiration. Well, they probably weren't actually planning on letting the trade play itself out. That's just the truth. A lot of people do that. They kind of have different expectations. And so if you let it play itself out, the truth is you're going to receive that premium regardless. It may not show up on your balance sheet yet, but you will receive it. All right, so here's a couple of cool ways you can think of the covered call. Number one, yes, you can use it to lower your dollar cost average. And if you've been buying position trades and you're used to this idea of dollar cost averaging down, the covered call it should be your best friend. It is a great way to lower your cost basis. It's a great tool to create monthly income. These are the two biggest reasons that people use covered calls, in my opinion. But a third one that a lot of people don't think about, this is like the ultimate dividend. If you're a dividend trader, let's say you've been buying stocks because they pay dividends. I'm going to be honest with you. Dividends stink. They really do. I mean, the amount of money you make on a dividend is such a small, minuscule amount of money. And you can make usually 3 or 4 times that with 1 month of option premium selling a covered call. But the cool thing about the covered call is you can do that over and over and over again. You can do that 12 times throughout the year. If you're trading a stock that has weekly options, which most of them do now, you can do that 52 times a year. So that is the ultimate dividend. Imagine getting the dividend money every week over and over again. That's what you can do with a covered call. So it is the ultimate dividend. If you like dividend investing, you really need to learn how to trade with covered calls. And I say this is the way you can guarantee that you're going to beat the S&P 500. You may have heard me quote the statistic that professional fund managers, according to Spiva, 94% of them cannot match or beat the S&P 500 over a 20-year period of time. That's a published study that SP Global has put out for years. And they update that every 6 months. The numbers change just slightly between each one of the surveys, but it's roughly 92 to 94. Sometimes it's as high as 95% of professional fund managers cannot match or beat the S&P 500. Well, that's an abysmal number. It's easy. All you need to do to match the S&P 500 is buy SPY, buy the ETF SPY, buy that exchange traded fund, and then sell covered calls. That alone, you'll match the S&P, and then sell covered calls on it, and it's a way you can beat the S&P every month. I mean, it doesn't need to be rocket science, folks. This can be easy. Let it be easy. Now, if this sounds crazy, you're like, I have no idea how I would even start doing that. Fantastic. That's why I've put together some great training for you. And I have a new training called the Retirement Wheel, which uses this strategy as part of a monthly or even weekly cash flow plan to use your money, your retirement money, or whatever money you're trading. If it's 50,000 or if it's 100,000, whatever amount it is, if it's 10,000, doesn't matter. You can do this with almost any amount of money. You need a little bit. It's going to be hard with $200, but if you have a few $1,000s to start trading and you can go buy some stock, you can execute this strategy, and it's a great way to create predictable weekly income or every other week or monthly income, depending on how you decide to design it. But I'm going to teach it in this program called the Retirement Wheel, and we're teaching it right now. If you're watching this video at a later time, it'll be available in the form of recordings. But if you want to participate in the live recordings or the live teachings of it, it's happening right now. So get over to trademaestro.com and check that out. And listen, if you haven't done so already, like and subscribe so that you get the notifications and when we're putting out another video and when we're doing live streams and all that great stuff. Because, hey, I know this is great stuff, and the truth is most people aren't teaching it to you. So you're going to want to come right here to get it. Thanks again for watching. I hope you guys have gotten a lot out of this. If you have any questions, put it down below, comment, let me know. And until next time, I wish you the best. Happy trading. We'll talk to you soon.